give you a little bit of background on myself. So I'm from Ohio. Flew down here reluctantly in the winter. It's terrible. Hate to do it. But graduate of The Ohio State. So Buckeyes. That's great. I love it. So I went to law school, did all that fun stuff. Where I kind of focus my efforts is really around business planning and tax planning. So we said, what would be better at the end of the night than to talk about taxes? I love it. That's what we're going to do. I want to give you a couple of tips and tricks, just that I see other folks maybe know that, unless you're exposed to it, you just don't know. So that's actually one of my favorite guys. He was quoted by, if you know Milton Friedman, if that rings a bell to you. So there was a guy, his name's Milton Friedman, if you've heard of him. He was an economist back in the day with Thomas Sowell, if you know Thomas Sowell. Great economist back in the day. And the one thing that TR said kind of made me think of it. He said, it ain't what people know that causes trouble. It's what people know that just ain't so. And I think that's very true. A lot of folks probably are in the notion that, I know this business partner and they did it this way, so that's the way I should do it because they're successful. Or my parents got me the business this way, so I'm going to set it up that way to give it to my kids, and they were successful. But it's the things that you think are so, there's a lot that's changed. The big one that changed recently, which I'm sure you all printed off, have it on your nightstand, it was that big, beautiful bill. 1,000 pages of fun stuff. If you get the chance, I know he's passing out books, but you want to read through some fun tax code? Woo! We'll bring that as a giveaway next time. But there's a couple of big provisions that really affect business owners. So I wanted to touch on that, but anything else you want to ask, feel free to. But I think one of the big things that I would keep in mind as you're kind of going through, what's affecting me under this bill? What should I do to maybe structure myself to sell in the best way? There's some really, really slick stuff. First one I'll give you, it's a way that you can sell your business and not pay any capital gains at all. That's pretty attractive. Not too bad. So there's this fun code section out there, and it's this Internal Revenue Code. They call it 1202. I know my handwriting's a little, you're going to think I went to Michigan, not Ohio State. Nobody's perfect. It's okay. So this code section, I like it. This code section, if you can qualify, you can sell your business per founder and you don't pay capital gains on up to $15 million per person. Up to. That's per person. So if you're married, that's your spouse's amount too. If you've got kids, that's each kid that you have too. That's pretty nice. There's a catch though. So this just came out. One of the catches though is you have to be a C Corp.
Why is that?
That's just how it's structured. So it's only for C Corps. So a lot of you, I'm sure, are probably S Corps or you're a partnership or something like that. That's still good. I would still do that because another great code section I would definitely ask your CPAs about is this other one. It's code section called 199A. Has anybody heard of that one? I love it. This is a really, really nice provision if you're a flow-through business, so that money just hits your bottom line. This provision, they made it permanent under the tax code this last round. And this one says any money that flows through to my bottom line that I don't take as a wage or do write-offs, that money I get to take up to a 20% deduction. So if you made $100,000 that hit your bottom line, you're only paying tax on 80. So one thing I would ask all your CPAs out there is, am I maximizing my 199A deduction? Because if they're saying, well, you should take a W-2 wage, you should do all these things, do all of that to be reasonable, but as much as you can push to the bottom line, that's going to improve your cash flow. Keep the money that you should be keeping. Pretty nice. The other thing that's real nice if you're an S Corp too is if you take money out as a distribution, you take it as that bottom line, it's coming to me money, you don't pay what they call self-employment tax. So you don't pay FICA and FUTA, so Social Security, Medicare, all that stuff, you don't pay it. That money just hits your pocket a little better. Not too bad. Taxes are fun, even at 8 o'clock at night. I can feel it. It's good stuff. So leverage that one. So the nice thing with this little code section though is, well, if I have this type of business, my income might be pretty nice, but I think I might sell. And if you're thinking of selling in the next couple of years, it might make sense to start looking to set up one of these, a C Corp. And I would say that's really good if you've got maybe an employee, a couple of employees, if you have a lot of marketing, if you've got a lot of finance or other things that you're doing. If you set one up today, one of the requirements too is you have to own it for at least 3 years. 3 years, that'll get you 50% of this 15 million. So 7.5, you can, sell it 7.5. That's great. That's not a bad day either. If you hold it 4 years, then it gets you 75%. And then 5 years, you get the full benefit, 100%. So I think one of the big things I would say to just kind of prevent some of those failures too is just knowing what questions to ask. So if I know I might sell in the future, how am I set up today to make sure I maximize my walkaway number? That's the big thing I would push for.
Can I ask a question?
Yeah.
So you're saying if you're for a C Corp, you're entitled to 3 years, you're entitled to 50%?
50% of that 15 million. That's right. Yep. So it's a pretty good deal. The one catch too that I didn't mention is if you're in any sort of professional field, so I know there's a couple of finance folks, there's some other folks that it's tied to more your profession, this code section doesn't necessarily apply. But if you have marketing, if you've got staffing, if you've got IT, any of that stuff, if we push it into this entity, that can apply for it. So it's all in how you kind of show yourself to the government when you go to sell. That's going to hit you the best.
So there got to be a reason that they're pushing you to get in the C Corp. Do they get more taxes when you're in the C Corp or something?
Well, so that's the other kind of neat thing too. So this one, the most you should ever pay as a flow through is 29.6% federally. The most as a C Corp you're ever going to pay federally is 21%. But there's a catch. The one catch with a C Corp is if I want to take money out of this C Corp business, I already paid tax, right? I paid tax as a business at 21%. But then if I want to get it out to me, how do I get it out? I've got to take it as a wage, or maybe I've got to take it as a dividend. That hits me as taxes. So they can double tax you. But there's a third way. The third way is you can take it out as a loan. And as a loan. The fun thing about loans is they don't show up at all. So the way I would structure it is that loan is going to be paid back when you pass away. And kind of. That's right. And the thing is, you're still going to make it an arm's length transaction. So you charge an interest rate that's 4%, but it's money that's going from, yourself back to the business that you control. So it's not like it's a bank you're giving it to. You're just paying yourself back.
If you borrow money from yourself, but you don't pay yourself back, will you sue yourself?
Might as well. It depends on the day you're having.
What kind of insurance you got behind?
Yeah, that's right. That's right. Well, so that's the other nice thing too. So each year I can make a loan, and if it's 5% interest, because that's where interest rates are today, if I want to refinance, I refinance with myself, and then I drop it down to 2%. So you control the whole transaction, but now you're at 21%. That's not bad. I love paying less tax. Taxes are fun. We'll get there. They can be fun. But when we do this, right, if I've got a loan, what I can do, because I control the business, is Well, if there's a year that I've got maybe a loss that I can offset because I had a bad year, I'm going to show that loan. I'm going to claim it as income. So then it starts to deplete that. It's not on the books. It doesn't look too wonky. I just forgive the loan because it's myself. And it doesn't show up as income because I had that loss to offset it. So there's a lot of flexibility with what you can do. Kind of neat. Taxes are they're a little fun, but this one's really big. If you think you might sell, that's where I would get in touch with Randolph and say, hey, I think I might have this liquidity event sometime in the next couple of years. What am I doing today to set myself up so I don't pay taxes in the future? Because taxes are elective as long as you plan for them. But if you come to him and say, hey, I'm selling tomorrow, I'm getting my check, he's going to say, that's nice. Did you write another check for the government? Because that's what you're going to have to do. So plan ahead. Plan ahead. That's going to be a big, big one.
What's that called?
Yeah. So they call it 1202 stock, or you'll also hear it they'll call it qualified small business stock. And that provision, it's actually been around since 1993. So it's not something new. It's just how often do you sell your businesses? Not every day. So you don't run into it as much. Yeah.
As a lawyer, do fiduciaries also having the same knowledge and information you have, if you share with us?
Maybe. Depends on who you work with. So I would say the nice thing about what I do is I don't practice myself. I just educate and motivate. So I would work with your attorney, your CPA, with Randolph as well. And then we would walk through and say, yeah, this is something I would talk to, or this one doesn't make any sense because your situation's different. So yeah, that's why it's nice being part of his team too, because we can say, this is a value-added service being part of this group. So yeah, leverage us. I'll screen my calls in advance. Is that what you're... No, happy to help any way I can. The other real big thing I would think I would have everybody in the room that's a business owner go through is there's been a lot of changes as far as just valuation. So if you haven't had an informal valuation done of your business just to see what it might be worth, I would go through that process. It's not very intrusive. It doesn't take a lot from you, but it's really good to see where you're at today coming out of the pandemic. Your value's probably changed. If anybody did PPP loans or ERC credits, any of that stuff, that affects your value. And most of it's positive. But it might be a case where you say, well, gosh, I didn't know I was worth that. Do you know of anybody that could buy me? That's where we've got a network as well that we can help with some of that too. But that's a really interesting one. There's some things that we kind of discover through that process too. Like, gosh, I've got a building. How am I taking my interest? Or I got this new loan. What can I now write off because I got that loan? Loan interest is going to be real big this year for you all too. If you have a loan, you're able to write off a little bit extra in this year now too. It's going to be a good year to be a business.
Does that also include SBA loans?
So it can, yeah. So the old calculation that they used to do, just to throw all kinds of little figures up here, it used to be EBIT, so earnings before interest and taxes. That used to be what they would say your interest on a loan, you can write off 30% up to that figure. Well, they gave us an extra treat. They added a duh to it. So they gave us a duh under the tax law. So now we get to write off against depreciation, amortization added back. That's some big money potential. So if you've been thinking about expanding and taking a loan on, well, you might be able to write off a little bit more this year because of that. Kind of slick. Yeah.
So you gotta have a good accountant who knows the code, right?
The one thing I see, and this is attorneys too, because we can bash them because nobody's an attorney in the room. We'll pick on them a little bit. So what I tend to see with a lot of folks out there, CPAs, attorneys, CPAs tend to record history. They don't tend to write the history. So you need a good CPA, a good attorney that's going to help you write what you want to have as an outcome for the year, as opposed to going to them and saying, here's what happened, what can I do? You need somebody that's going to write that history with you. And let us know. That's where Randolph and I, we can chat. Nor too. Nor's in the back. I don't know if we introduced Nor. She's my go-to with Pacific Life. She's my wholesaler down here. So anything tough, throw her way. That's why we brought her. No, she's great. But yeah, we can get you some good folks if you don't have somebody. I love it. You made it through most taxes at night. This is great. What other questions can I give you? I threw some stuff at you, liquidity things. There's some real neat things you can do on the charity side this coming year.
Can you talk a little bit about that?
I can. So one thing that they allow you to do now is everybody in the room, whether you're filing just that standard deduction, which most folks do, or you do itemized, everybody can get a little extra perk up to $1,000. You can give to charity. You get to write that off. So that's great. So whether that's church, whether that's a local cause, have at it. The other thing I think you're going to want to look to is your CPAs are probably going to bring up a term, they call it charitable bunching. That's a term that says essentially if I used to be a person that itemized my deductions because I did certain things, they might say, well, instead of you giving that money every single year to charity, let's bunch it together in 2 years. So you don't give to charity the first year. You take your standard deduction. That's going to give you more money back. The next year, you give them all. So instead of, say, $5,000, you give $10,000. You're going to get more bang for your buck. So that'll be something, too. I'll give you one bonus one, too, just because I love acronyms. If you haven't caught that yet, acronym city here. There's another really big one when it comes to your just business planning. There's something out there called a charitable remainder trust. Has anybody heard of that? I love it. Good. So this one's really neat. Whether you love charity or not, the one charity I think most folks don't want to give to is the government, unless you have to. Just a thought. So what this does is it gives you some perks. So say I've got a truck or something that I wrote off everything. It was a $90,000 truck. I wrote it down to nothing. If I sell it, I've got a lot of gain, and that gain's going to hit me. If you give that to a charity through this trust, you don't have any of that. There's no gain. The one catch, though, is 10% has to go to an actual charity. 90% of the value of it. So say I sold that thing for $100,000, $90,000 comes back to me. And I can pick the terms of what that is too. So if I wanted over 10 years, that payment back, great. If I wanted over 15, 20, if I wanted over my lifetime, I can do that too. And you get to choose who that 10% is. So I could choose a church if I want to, or I could choose something called a donor advised fund. And that donor advised fund is kind of my legacy for the community. So I can change who the benefits are every year. My family can control it the rest of their lives. A lot of good flexibility, but that's one strategy if you're dealing with something you're selling. If you're selling your business, have the charity sell your business. You're getting 90% of the value back, but you're not getting any of the tax.
So what are the restraints on that? Can you sell something big every single year?
Sure. You got it. Folks just don't know. Yeah. Yeah.
One thing I'm trying to wrap my head around, so you have the charity and then you have the word trust in there also, which is another thing.
Yep.
That is tied to organization.
So it is when you sell it, you've actually given that asset to the charitable trust.
Okay.
So the charity is kind of the benefactor of that trust, but you're the one giving it to this trust. And that trust is going to say, I'm selling it to whoever. So you lose a little bit of control there. So it doesn't work if you're going to give your business to, say, your kids or something like that, or you've got somebody you want to go have your business to. That charity is going to do whatever it wants with it.
But really, you're just giving a minimum of 10%, but you can give a maximum of 100%.
Or you can give whatever you want, yeah. Yeah, but this is a good way that you pick who gets it instead of the 20% to the government because you sold it. You're choosing who gets the 10, and you manage it too if you want to.
But if, let's say, that person wanted to just give 100% of
Oh.
the business to the charity.
Have at it. You can still do that.
Okay.
Yep. The other nice thing too, is since you did give at least this 10%, that's how much benefit you get as a charitable deduction too. So you get that the year you gave it to the charity. So it gives you a little more flexibility to say, well, yeah, I'm going to have a little bit of gain, but it's offset by what I gave to the charity that I control. Yeah.
You said that the charity can sell the business.
Mhm.
How does the charity do the business? Am I donating it to the charity?
Yep. Yep. So you're setting up this trust, and then that trust, the trustee, whoever's in charge of it, they're going to put it on the market. They're going to sell the assets, whatever they want to do. They're going to do that.
So, question, follow-up question. For people who are interested in government contract,
Mm-hmm.
and that want to get socioeconomic set aside certification.
Yeah.
They don't know what it is.
Yep.
If the business is owned in a trust, do I still have the ability to get those certifications?
It depends. Is that a good legal answer for you? So I would say, it's great. I gotta give one. So if you're gonna sell your business, you're out. So you probably wouldn't be getting those certifications, wouldn't be getting those. So this is when you're done.
The trust is not a physical person.
That's right.
So the trust doesn't have a socioeconomic.
Yeah. So what they're probably gonna say is, if the value of the business is say $1 million, because you qualified for those government contracts or some of those benefits you're receiving, if they sold that business to a similarly situated person, that value is probably still going to be about $1 million. But if they sold it to somebody else that couldn't qualify, then maybe the value drops to say $700,000. So it changes your benefit at the end, but it depends on who they sell to. And you could probably have a little bit of sway to say, this is my business, this is the value, this is why the business is valued this way. So if you sell, take that into context. And that's why you'd get a good trustee that's going to know those things to say, yeah, I want to maximize your value. And that's kind of their duty as well. They've got a fiduciary duty to do that.
So, another question.
Yeah.
Last question. You
Yeah.
said that we should get our businesses evaluated.
Mhm.
What are some of the benchmarks to know that we're ready for the business evaluation?
So I would say if you haven't had one since they did the big beautiful bill just in July, you're probably not where you were before that from a valuation perspective, just because they changed some of the metrics. So you probably have more value than you think you have. So if you haven't had one recently, I would definitely do it. And it's something that I'll work with Randolph with, and it takes maybe 2 to 3 days. So it's pretty non-invasive, that sort of thing. A couple years of financials. Let me know anything that's unique about you, what you're doing, that sort of thing, and yeah, we'll get it to you. And then show you some of these things, like, well, gosh, if you did this, you'd be able to sell for this, or yeah.
Couple of questions.
Yeah.
So, like, let's say you're setting yourself up to sell your business or whatever. I know that you can get an evaluation done and you can take out a larger loan before you sell it to increase the value of that business. It's attached to the business, so you can do that. It's still turn and donate or.
So that's getting a little far. I love where your mind's at. I love it. So there's guardrails when it comes to taxes. That's kind of on that edge of the gray. Yeah.
You could still, okay, let's say, I heard about this from a friend of mine that helps sell businesses.
Yeah.
But there was an older gentleman, he was a Christian,
Mhm.
and he wanted to, because he had already had the systems and everything set up for the business.
Yep.
He's a multi-millionaire. He wanted to donate his whole business, not to sell it, but to donate it to a nonprofit that would use it to educate and make other people wealthy.
I love that.
Through his thing.
Yeah.
So could he use the CRT and donate the business as is?
Yeah.
And still get the write-off and they could still use the profits?
Oh, yeah.
Okay.
Oh, yeah. And he could even do, so there's another one too, just to throw it out there. There's another one called a CLT, a charitable lead trust. So charitable lead. So this was a remainder. So the remainder, that 10% goes. This one, you lead with the charity. So you lead with giving the charity everything, and you give them essentially 80%, and 20% comes back to you. So if he's more on that mindset, you want to give and make sure that that benefit continues on, you get 20% back, 80% goes, but your charitable deduction is 80%. So you get a little just different play on it. I love it. I love it. Yeah. So there's a lot of things. That's the biggest thing I would stress to you is if you think you're going to do something that involves taxes, structure, give us a call. We don't charge anything. You can pay me what you want. I love those tacos. No, something like that. But I just want to empower folks. Yeah.
So, if you were to want to build a community where you had like assisted living and children's homes,
Yep.
then you could use those funds that you put into the CLT to do that.
How about even better?
Okay.
I love this. This is great. Taxes are getting fun now. Woo. So there's another thing out there that's coming out this coming year, at the end of next year. You might have heard of this. They call it a qualified opportunity fund. Has anybody heard of that, or qualified opportunity zone?
Yeah.
Yeah. So they're coming out with version 2.0, which is great. So that one, if I have any sort of capital gain, so I go sell my business, I've got a lot of gain, or I sell stocks or whatever it is, I can throw money into this opportunity fund. That fund, I get a couple of perks. I don't pay tax for 5 years at all, so no tax. If I take that money and invest it into what the governor is going to view as, say, rural, some sort of rural space, I get a 30% decrease in what I will pay in taxes. That's big. So if it's $100, I pay tax on 70 cents or $70. That's not bad.
Is this specific for capital?
It is. But it can be short-term or long-term. So if you want to do crypto mining in the next couple of years, have at it. You want to day trade, have at it. No tax for 5 years. But that, if you invest into the rural space, have those communities, you invest into that, you've got some massive perks. The other really big perk is if you hold it for 10 years, so you're developing it, you're growing that community, you're doing all those things. If you sell it after 10 years, after you've already paid that tax, say you threw in it was $100,000 and it grows to, say, $1 million, all of that gain that you've got here, after 10 years, you don't pay a penny. So you'll never pay capital gains when you sell it. It's pretty neat.
I didn't catch too much of the 30% exactly.
So if you invested into some rural market, and if you go online and Google opportunity zones, you can pull up maps and it'll show you this area, it'll show you anywhere in the US you could invest. If you invest into rural, you'll get a 30%, they call it a bump in your basis. So if it was $100, you're only paying tax on 70. If it's urban, you get 10%. So you still get a little kick, but after 5 years, you got to pay tax. But it gives you 5 years to figure out how to pay that tax. And even if you had to sell this property to pay the tax, we already got an increase in your basis of 30%. That's not bad. It takes a little bit of that risk off. Woo. I love it. I love it. Does this give you some things that maybe you haven't heard of? A little bit? Just, I would say big things. Ask your accountants, ask your attorneys, are you maximizing that 199A? That'll free up a lot of cash. If you're selling, am I in the right business structure? And to find those things out, do that informal valuation. Get with Randolph, we'll do that for you. Let you know anything that we saw that maybe your peers are doing. We can get you kind of going.
But if they were doing the CRT at 100%, it doesn't matter if it's an S corp or C corp.
Doesn't. Nope. It doesn't matter if you owned it outright, if you, anything you want. Could be stock that you've got. Yep, anything that's got a lot of gain, these are really good tools. I love it. Well, I appreciate it, y'all. Late night dealing with taxes is great. Thanks, everybody. Cool.
All right, everybody give it up one more time for Ryan Patton. Did y'all learn anything?
Oh, yeah.
Yeah, those opportunity, one thing about it, no matter, like TR said, no matter what side of the political aisle you're on, you got to realize where you're at, what's happening. What is likely to happen with taxes whenever a Republican is the president? All right. Do y'all like paying voluntary taxes? Do y'all believe all truths are parallel? Do you know what I mean by that? What's usually true and workable in one facet of life is true and workable in another. If you were to go to a farmer and you ask the farmer, would you rather pay taxes on what it costs on a handful of seeds or a field full of crops? What do you think that farmer gonna say? Why do you think that farmer says that? Yes. If you are in a year where you know that taxes are lower, no matter what side of the political aisle you're on, you need to get a valuation of your business. And even if you don't have a business that you think is worthy of valuation, let us tell you that, right? Even if you don't have your business going, you need to get a valuation of yourself. You are a business. Everybody needs to get that valuation, because guess what? What if you find out that right now, if you don't convert certain types of certain capital and principal that's in a vehicle that isn't advantageous to you, and wouldn't you rather find out now while it's still a button seed and then pay taxes on that in a year that taxes are lower before taxes go back up, right? So I want to thank you again, Ryan, for sharing that with everybody. And just so y'all know, that qualified, because I didn't hear about 2.0 yet. I'm about to read up on the Opportunity Fund and the Opportunity Zone. At least from what I recall about the Opportunity Zone is, did y'all know, like, so, and let me know if this has changed, Ryan. But what you do is you fill out a short form and you send it to the IRS, and that's now your Opportunity Fund. You're not asking for permission. You're just making them aware. And as soon as you put that money in that Opportunity Fund, it's tax deductible in that year. And as long as you use that Opportunity Fund to do things in the Opportunity Zones, I believe up to at least 90% of it, as long as you do that, why not take advantage of what's going on? So thank you, Ryan. So